Global group. So Max, this session, our bootcamp week, it's open to Extreme Tech Challenge Startup Global finalists, and they're joining from over 100 countries. So we're super global, and we're in places where Orrick is.
Perfect.
Yeah.
I'd like to hear.
Great, awesome. John, do you think we can get started while other people file in? How are we looking?
Just a minute. Okay, we should be going. So anytime you'd like to start.
Awesome.
Now mute.
Thank you. I want to welcome everybody to the Extreme Tech Challenge 2022 Bootcamp Week, where we host talks and workshops led by investors, corporate leaders, and experts covering a variety of topics designed to help you and your startup succeed. Today, I'm so delighted to welcome Max Cantor to lead our session on Term Sheet Teardown. Max is a partner in the technology companies group at Orrick, who is a leading international law firm founded in San Francisco, now with offices in over 27 locations worldwide. The firm advises on transactions, litigations, and regulatory matters for venture-backed companies, public companies, E&I funds, financial institutions, and governments. So with that, you all had a little bit of homework. We share a sample term sheet that we will be going over today. So with that, I'll turn it over to Max on term sheet teardown.
Yeah, so great to meet everybody. Super excited to be here and to support. So like Victoria said, so I'm a partner in the New York office at Orrick in our technology companies group. So our firm does everything under the sun, but our group, we focus exclusively on representing startups, high growth tech companies, and VC funds and growth equity funds on everything that you would think, right? We're doing everything from formation all the way up through IPO, exit, and every financing round in between. The idea today, I guess it'd be helpful, maybe Victoria, what are most, in terms of stage, where are we mostly sort of pre-seed, seed? What's the group makeup?
So maybe everybody, you can type in your stage in chat. Max, you can take a look.
Yeah. Okay. Got it.
So early as you would expect.
Yeah, so I'm gonna go ahead and share this term sheet, which is one of 10,000 open documents. So just give me 1 second. Whoops. That's not right. Sorry, would you mind, Victoria, sharing? I'm having some kind
of course. Yeah, I'll do that. Give me a sec. All right. Share screen. And you just tell me how to navigate. And also, someone on my team, can we paste this in chat, please? I'll do that. I'll do that.
So let's start with just.
Is this good? Is this good size-wise?
I think that's fine. Yeah.
Yes.
So let's start with just a general overview, right? Fundraising landscape. So obviously right now is sort of is a tricky time. I'm sure you're all hearing too much about it. Everything's scary. You know, a lot of that is not true. Some of it is true, right? We do a significant number of transactions, thousands in a year, or hundreds and many hundreds, many billions of VC financings. And what we can say in terms of what we're seeing out there is, yes, there are drops in valuations, and yes, round sizes may be decreasing, but a lot of that is at the later stage, right? We have not seen a corresponding slowdown in seed and A rounds like we have at sort of the late stage, which is a result of pullbacks from sort of what we'll call crossover investors, right? Who are really sort of basically hedge funds that invest in the late stage market. So that has impacted early stage financing terms, right? The pullback to some degree, but we are not yet seeing sort of what we've seen in prior down markets, which can be very aggressive terms, which we'll get into in detail what those might look like and are things to look out for. Basically, if you see this in a term sheet, call somebody because it's not normal. So right now, everything is still sort of functioning as normal and the market is still moving and highly liquid. It's just, valuations may be a bit lower. And there may be some other, governance terms that are stricter. So I know we only have an hour, and I could spend 10 hours running through this term sheet. For those of you that are sort of foreign folks or are currently, incorporated somewhere else, it may be that part of this is not, the most relevant, but generally speaking, in most markets, a lot of these points do track, right? And the other reality is for many of you who are raising capital in the US, especially if you're outside of some of the sort of core venture jurisdictions like the UK or Canada, where you may stay, you may ultimately, if you haven't already, end up doing a share exchange, right? Where you flip your, Swedish corporation or AB into a Delaware company, right? So significant portion of the world's venture capital is raised in Delaware corporations, and that applies regardless of the countries we're talking about, right? There are some countries like the UK and Canada being the prime examples where people do tend to stick with their own countries and they don't flip. France is another one, but for many folks all over the world, Delaware is sort of your destination for where you want to incorporate. And a lot of the reasoning there, it's not a special tax haven. It's not some magical place where wonderful things happen. In fact, if you've ever been to Delaware, it's not much to look at all. But it's just that it's what everybody's comfortable with, right? VCs are very creative in terms of what they like to invest in. They're not very creative in how they like legal documents to look and what kind of rights they're looking for and what kind of sort of key financial terms they're looking for. They want everything to be clean so that you can concentrate on running your business. And therefore, that's why it's, a term sheet like this term sheet is from an actual deal that closed, I think, in December. So it's a real term sheet with redacted names and a couple brackets and added things just so we can walk through it, but it's real and it's very predictable in terms of sort of what's out there. We can sort of get a good feel for what you should expect to the extent you're raising from a big US VC fund or a small US VC fund and even a number of other funds. So let's scroll to the top. So in terms of breaking out this conversation, we probably don't have time to run through anything, and I want to save at least 15 minutes or so for questions, or potentially 20, because I think that can be more interesting. But I think what we'll want to cover are the financial points, right, and the key governance terms. And we can just sort of roll through this thing like that. Maybe let's zoom in a little more, Victoria, just a tidbit. So for those of you who have raised a seed, you probably, it's called, Series Seed preferred stock. For those of you who haven't, and you may hear people say the words Series Seed, Series A. Those are not real terms that actually really mean anything. They're just things that we as a market have associated with certain stages, right? You could call your preferred stock or your round Series Elephant or Series Zebra if you wanted to. It doesn't matter. It's just sort of market parlance, right? To say your stage. What constitutes a seed, what constitutes an A, seed deals 5 years ago were 2 million, now they might be 8. Like, things have changed a lot, but at the end of the day, it's all just a form of what we call preferred stock, right? Which is just a form of stock that has special rights and privileges, right? It's a different class or series of stock that is assigned special voting rights and special economic rights. That's all it is. There's nothing else magical to it. What the type of stock that is issued in venture rounds is convertible preferred stock, right? You may hear the word preferred stock in connection with like the public markets or sort of non-venture, non-growth financial markets. That type of preferred stock is often very different. That's much more like a debt preferred stock. What this preferred stock is it gives the investors a series of financial rights and governance rights, but allows, upon an exit, assuming everything goes well, for the preferred stock to convert into common stock so that it sits equally with you as the founders and all your employees, and they share in the same rights as everybody else. So for example, let's say you're a seed company right now, you're doing well, you end up selling your company for $1 billion. If you sell for $1 billion, and assuming you didn't raise some crazy valuation or agree to some weird terms, they're going to participate based on their ownership percentage. If they own 10% at the time of exit, they're going to get 100 million, just like you would, right? There's no difference. We're going to convert their preferred stock into common stock, and they're going to be paid out based purely on percentage with no sort of special exit rights. And the same goes for an IPO, right? When there's an IPO of a company, we do not register preferred stock in an IPO. It all automatically converts to common, and that's what's sold in the IPO, right? So yes, initially you may have differing sort of incentives from your investors in the sense that they may have special rights and certainly special governance, but the goal is to align you long-term so that you're sitting in a place where when you get to exit, everybody's going to be in the same shoes and you're all sharing in one pie. So let's run through, right, just from the top, and I'll just sort of move relatively quickly just because of time, highlighting a few key points, and then as we'll stop, I think, at with 20 minutes left for questions. And we can also, if people want to put questions in the chat, we can do that also, so we can monitor if people are, if I'm moving too fast through one section, feel free to throw it in the chat, and Victoria, if you could flag for me if a bunch of people are saying something, we can do that. So securities to be issued, right? Series C preferred stock, we just covered that. Aggregate proceeds, right? This is just the amount you're raising, and that there's always going to be, or there should be, a lead investor, right? That lead is putting in a portion of the total. What portion of the total amount varies significantly. I would say that traditionally, in order for it to be considered a lead investor and for them to set the terms and drop this term sheet on you, they would be investing at least 50% of the round. There are rounds where you'll see a lead come in with less than that, but typically it's there. So under aggregate proceeds, right, this is a fake venture fund. They're putting in 6 of 10 million. And then the remainder, we don't spell that out. So from a process perspective, right, you sign this term sheet with the lead. You don't have to sign up all your other investors to the term sheet. They just wait and get the final document. So you're not soliciting input from, 10 or 5 different investors. We just negotiate with the lead, which is why they're so valuable and important to the functioning of a deal process. One item I want to highlight under the aggregate proceeds, right, in the second half of the paragraph, we talk about safes or other convertible securities. So what we're talking about here when we say that safes or convertibles convert into a shadow series, right? So if you had a safe open, you can go pull one off the YC website. I hope you are all familiar with it, or if not, give one a look, right? Early stage fundraising tool. All this is saying is that the safes are going to convert into this same Series C preferred stock, and it's going to be identical in every way, except that the liquidation preference per share is going to be equal to their conversion price. What that means is that if you bought a safe, let's say I buy a safe in Ravi Sharma's company, I see him on here at a 50 million valuation cap, and then the round is raised at $100 million valuation, just throwing numbers out there, and that was equal to 50 cents per share and $1 per share. The liquidation preference per share on the stock issued to me from Ravi's company would be 50 cents instead of 100 cents because I bought a safe. That's it. So it's otherwise identical. It's really a technical point, but it's something that often gets confused. So I just wanted to highlight it. Closings is a pretty standard point. One thing that's always can be a friction point for especially earlier stage companies who aren't used to financing rounds as much is that you do need to have sort of a formal initial closing where you get all your investors together, or if you have one big lead, you can just close them. But these aren't done as like a safe or convertible where you can just on a rolling basis accept more subscriptions. Now, that being said, after your initial closing, you'll see in there we have 1 or more additional closings with 60 days. Those can be done on a rolling basis, right? So, but you really do need to pool everybody together. So if you sign one of these term sheets, you have to build in some time for it to get done before your bank account runs out, so you can make payroll, right? A typical round timing for a US deal would be about 30 days. For deals outside of the US, I think in our most recent report, it's closer to 45 to 60 days. So you have to make sure you're baking in that time into your fundraising process, right? If you're going to go out to market and you say, I'm going to run out of my runway is 4 months, that means you need to get a term sheet signed in 2 months. So just make sure you build that in. These are not super quick processes. Price per share is your next section, right? This is just how we determine the price per share, right? When we issue preferred stock, we have to turn those valuations you hear everybody talking about into a price per share. So in that section, there's 2 ways to do this. You can use a pre-money valuation or a post-money valuation. A post-money valuation, to be clear, all that is pre-money plus the amount coming into the round. That's all. That's just another way of framing it. The reason that many investors use the language you have here, which is a fixed post-money, is what that means is that we're saying the round's going to be 10 million. Often, if you're a hot company, you'll have a lot of other investors who are trying to put money in. You'll have more people trying to give you money than you have allocation. And what the $60 million fixed post does is it says that, okay, if you end up taking more than 10 because you decided you could really use that extra 2 million, that's fine. But what it will do is reduce the pre-money valuation, effective pre-money, so that you take the dilution and I, as the investor, don't, right? So that I know that if I'm investing 10 on a 60 post, that I'm getting 10%, and it's not going to be reduced just because you decided that you needed more money when we had already agreed that that wasn't the case. So, but they're not huge differences, right? If this was done on pre-money, it would say a pre-money valuation of 50 million. Instead, we're using a fixed post because that's what was done in this deal. The next point, which is key, right, is your option pool. So every time you do a round, and this is in terms of how you calculate the price per share, you're going to have to increase the available option pool, which is the shares set aside for issuances to employees or advisors or other service providers. That dilution from increasing the pool occurs on a pre-money basis. So prior to the calculation of the price per share. So if you think of this as a very simple division problem, right? Price per share in a venture financing equals valuation divided by fully diluted share count. That's it. So it's the simplest math in the world. There's some rounding in there, but that's it, right? So in this case, you would say, 50 million pre divided by whatever the number of shares you have outstanding are. When we increase the pool in connection with a round, what we're doing is we're increasing the number of shares in the denominator in that division problem, which therefore, when you have a higher denominator, you divide by a bigger number, your price per share is smaller. So for you as a company, while you want your option pool to be sufficiently sized so that you can, make key hires, don't let an investor force upon you a pool that is larger than what you need, because you're eating all of that dilution. They're not sharing in it typically. Sometimes investors will share, it happens, but generally it's very rare. It's maybe 10% of the time. So if you only, if you have your budgeted employee count out there and you say, I only need to make, 15 hires over the next 18 months, and that's going to only take up 6%, then you want to negotiate, down to a 7.5% pool. You want to leave yourself some flexibility, but you don't want some 20% pool that you're not going to use, because that you're the only one who's taking that pain and the investor is not. And so it's a place where, there's some overlap in your interest, but otherwise you're generally opposed. Ranking, right? So ranking, we can sort of ignore dividends, but ranking and liquidation preference, this is sort of the key feature of preferred stock. It's really the fundamental difference between preferred stock and common stock. And what it means is that they get their money back first before the common stock gets paid, if there's not enough money to pay back everybody. So a liquidation preference is, all that means is, let's say you raise 10 million, right? You had a $10 million round like this one, and then, things aren't going well and you sell your company for $8 million. the common stock is getting nothing, right? It's all going to go back to the preferred stock. There are different formulations of liquidation preference, but there is only one acceptable formulation, and that is what we call non-participating preferred stock. Non-participating preferred stock means they get the greater of, they get either or the amount per share that they paid in, right? Assuming there wasn't enough money to go out, or probably a fraction of that. Or if the company does well, right? If you're having a $1 billion IPO, then they're going to convert to common and they get that amount and their preference goes away. So the important thing to remember about liquidation preference, if it's done right, and it's what we call non-participating preferred, is that assuming you have a good exit and everything goes well, it's never going to matter or come into play, and it's irrelevant, right? But it is a protection for them for downside scenarios. The other type of liquidation preference that you need to watch out for, and it is, if we would have had this call 6 months ago, I probably wouldn't even have said anything about it, but it is something that always comes back in down markets, is what we call participating preferred stock. Participating preferred stock, they get their money back and then they participate alongside you. So if they invested 10 million, they're getting 10 million back, and then they still get their 10% share of the remaining pot. It's not a reasonable term. That's used in private equity a decent amount, which is a different animal, but in VC world, that term is considered very harsh. And if you see it and your company is doing well, then you want to flag out of there. I will see that question mark, and I'll come back to it as we go down, because we're about to get to conversion. So let's just scroll. So again, right, preferred stock this is convertible preferred stock. The way it works is that there are two ways it converts. There's voluntary conversion and automatic conversion, right? Provisions 1 and 3 there. Voluntary conversion is basically irrelevant for your perspective, right? It's not likely to ever happen. It rarely does. So you can sort of throw that away. We want it to be there for certain special situations, but otherwise we don't need it. Automatic conversion is where it comes into play, right? And this is, when does their preferred stock convert automatically into common stocks that are sitting alongside you, right? And that happens basically at an IPO, right? That's when that happens. That's the only time when it happens. If they voted for it, then you'd be good to go. But otherwise, it's really at an IPO. Usually there are some qualifications put around the IPO, like you have in here for what we call a QPO, to make sure, especially, and this is especially if you're a foreign company, that you're listing on what the investors consider like a legitimate stock exchange, and that it's not a little small IPO. Certain markets like Australia and Canada and a few others have special stock exchanges where you can basically do like a $25 million IPO. You can never do that in the US or not even in London. So it's sort of, they're just protecting against you doing some little dinky IPO where they end up getting nothing and they lose all their rights, because once they convert, their rights are gone. If you were a European company or you were a Asian company, this provision would not just say NASDAQ or NYSE, right? It would include, the Euronext or London, or Asia can get a little more difficult because some investors have a lot of opposition to being listed on anything but maybe the Japanese exchange, but not super. And so let's keep rolling down. So the next point, if you could just scroll up a little, there's those two protected provisions section. So let's talk about governance. So we talked about, some key financial rights there about, the structure, convertible preferred, liquidation preference, how it sits senior to the common. There are other financial rights having to do with sort of pro rata and the things that we're going to get to on the next page, but I want to cover these two provisions you see here first, which these are the key governance rights. These are the voting, the control rights. This is really sort of what you're giving up in your company in terms of, these are items that you are, these protected provisions that you are giving to your investors and saying, I can't do this without your consent, right? two categories of these. There's preferred stock protective provisions and preferred director protective provisions. Preferred stock protective provision in its normal formulation, like you have here. And yeah, maybe we should zoom in on the top one because I probably want to go through these, Victoria. Is that you need the consent of a majority of the preferred in order to do certain things. Now, in the US market, in a healthy market, this list should be relatively limited, and it's a fairly standardized set of items, and you're looking at it as to what items should be included. There's plenty of negotiation on these. It's one of the most, these are some of the most negotiated points in a financing, because in a hot market, you'll want to say, that you don't get the right to tell me anything. And in a down market, they'll want to say, we want to have a lot of control rights. So the key items in here, right? And you can I won't go through them one by one, but the basic ones are selling your company, right? You want to sell your company, get their approval. That's what affecting a deemed liquidation event means in annoying lawyer speak. Amend your certificate of incorporation or bylaws, or your articles of association, depending where you're incorporated, right? That's just, making changes without their consent that are adverse for them. That's pretty basic. Creating or issuing new shares with rights senior to them or on par with them. What that means is raising a new round. So that's a key one to remember, right? Like, you don't, just because they invested doesn't mean you can then go out and, let's say you raise a Series A, go raise your Series B with that preferred stock having rights senior to you. You need their buy-in on that, and they need to consent. Sometimes you'll see this point negotiated, but it's very rare. Generally, people want to consent. Now, to be clear, investors are not in the business of telling you not to raise money. And this right is really to cover for if you're doing like a weird round or something you shouldn't be doing, or if they just fundamentally disagree that you need more money, perhaps. It's rarely exercised, but it is a blocking right. So just something to keep in mind. Distributing money or making a dividend, not a big deal. Changing the option plan, so increasing the plan because you ran out and you didn't predict it properly. That's a key one, right? They want to make sure they're not diluted by any increases to your reserve pool. So just worth noting there. There's usually oftentimes a debt block could be in here, right? You'll see that incurring indebtedness in excess of X. That is not in all of them, and that number flexes significantly depending on your business, your jurisdiction, and a lot of other things. So then let's scroll down. There's another set, preferred director protective provisions, right? These are another set of protective provisions that are associated with your preferred director. So in most rounds, your lead investor is going to get a board seat, right? These are things that require the approval of that director in order to do them. These are generally, they're less fundamental items and are more like governance items, like affiliate transactions, or I saw a question that was just in there about a founder selling their own shares, like that might be in here as something covered. It's meant just to make sure, given that they're not going to likely have a majority of your board, right? They might have 1 seat out of 3, that they need to be included in any majority vote to approve certain items. You can read through those. They're tend to be, more operational. The only sort of big differences would be in Roman numerat 9, you'll see what we call a pivot block, right? Which is entering a new line of business, exiting the current, or changing the principal line of business. What this basically is saying is that, and it, again, not included in every deal, this one can shift. If you raise $20 million for your, accounting SaaS company, and then you decide you're going to be a, CPG company selling cereal, you need to get somebody's permission. You can't just use their money for whatever you want. Then rolling down, that's a crypto block, a token issuance block. That's ubiquitous. It's put in different places, but everybody's going to want some general blocking, right? If you are a crypto company, then we need to have other conversations because there's other things. This term sheet is not really built for a crypto company. They are a little different, but let's keep rolling. So let's keep going down, if you wouldn't mind. So there's the board provision, right? That was up there. You can stop there. You have a board typically at your first priced round, and that's what this deal was and what this sort of talk is built around. You're going to be retaining a majority control of the board. Now, for those who aren't familiar, the board in Delaware and in the United States really controls the business. The board is the company, right? The board is what makes decisions. The board are elected by the shareholders, who are the owners, and then the board makes the decisions. The CEO and the other management team and the founders operate the company, but board control is really where real control sits. I see situations often where I'll talk to a first-time founder and they'll say, "Oh, I got this, I'm a fintech company, and this bank CEO says he's willing to be on my board, and he's not investing, but I think it'll add a lot of gravitas or be super beneficial." Like, that may be the case, but you are giving up control of the company potentially when you add those folks. Board it's not a vanity position. It's not something you give away so that you can use it for advertising. It should be because they purchased a seat, right, as a Series C director or preferred director, or because they're really adding value, right, and they're serving as an independent. You just always have to remember that, those seats have real power and they can turn against you. So that's that. Registration rights, super quickly. Those are the rights of the investors in the IPO. They're super specific and highly detailed, and it might amaze you, but we negotiate the rights that somebody's going to have in your IPO when you do your first price round. So in your first $2 million round, or your company's worth $10-20 million, we're negotiating all the details of your IPO in terms of the rights of the investors, right? Registration rights. But that's just the way it's done and needs to be done. But they're fairly standardized, so there's not a lot of negotiation, which is nice. Then the other sort of some key rights left, and certainly recognize I'm moving fast, but do want to get to questions. I think that's helpful. Yes, somebody can have 51% shares with no board seat. It's a good question, Sean Park. The way this works, right, is you give certain people the right to designate or elect directors. So, for example, your preferred shareholder is not going to own a majority of your company. That's not really if somebody's buying a majority of the company, it's not a venture round, and this presentation is not for you. But that person may own 10%, but you're giving them the right to designate a seat. You say a majority of the preferred stock, so not a majority of the whole company, right? And the same similarly goes for common stock, right? We say a majority of the common. It would be pretty tricky for somebody to have 51% and not have the right to a board seat, but you can negotiate anything you want. We have the power to do anything, but that would be pretty rare. It'd be sort of an odd situation where that would come up, but it is totally possible. So next quick items to cover are financial information and preemptive rights. Preemptive rights is pro rata rights. This is the right to invest in your rounds going forward on a pro rata basis. So basically to maintain their ownership percentage. Extremely important right, probably the most important right for an investor in terms of the other than the basic liquidation preference and such. This right, from your perspective, is something you have to give out to folks. It's very difficult not to. However, you need to limit who it goes to as much as possible, or you should. We typically only give it to what we call major investors. It's just a defined term where there's a value set. So usually we like to peg it to capture only maybe the 2 or 3 largest investors in a round. The reason that we want to limit it, you may be saying to yourself, but if somebody wants to keep investing in my company, why wouldn't I like that? Like, that's great. You want to give me more money? Sure. Like, that sounds wonderful. It sounds wonderful, but if your company is doing really well, you're not going to have a problem raising money at all. No way. And then what ends up happening is you have dozens or 5 or 10 investors that have the right to participate, and they're taking up round allocation in that round, and that can cause problems, serious problems, because often later stage investors and even early stage, they have minimum percentage thresholds they're trying to get to. And if you're trying to raise 10 million and they need to invest 6, as that's their fund strategy, they have to invest $6 million out of your $10 million round. You don't want to have to be carving them back and saying, no, sorry, you can only invest 5 because I have to give my early angels pro rata rights. So you really want to try to avoid this as much as you can. So that's that. Financial information, that's just your right to receive customary financials, quarterlies and annuals. That's also similarly limited, and that's more of a confidentiality point and a control point. You shouldn't be giving those out to every little tiny investor. They don't need them. If they request them and you want to give them out, you can. You just obviously want to be careful about, that information sort of getting out into the world. I'm going to skip drag along for now, mostly because it's not in a lot of the jurisdictions on this call, it's not super applicable. But what it really means is that you can force small holders to sell if there's in an exit transaction, if there's certain thresholds that are met in voting. The point there being, you don't want a 1% holder of your company blocking an exit transaction or an M&A deal, right? Just because you're like just one person or somebody you can't get a hold of who won't sign. We want to be able to what we call drag them along and make them sell with us. Next is ROFR rights. I've seen a couple questions, I think, about founders transferring shares. This is that provision. So the answer to the question, can a founder sell their shares, is it depends. Generally speaking, founders are restricted on making any transfer of shares except for in certain circumstances, right? Those circumstances are generally these items listed here, which are, if you transfer it to your wife for estate planning reasons, or your husband, or you are, transferring it to a trust or some other entity for estate planning purposes or something of that nature. There's also usually, and there should be, and you should argue for this, a de minimis exemption, which is if you sell less than 5% of your shares, it's fine. And what these rights are saying, we call them, this is a right of first refusal. It's not that you can't necessarily do it. It's that the investors have a right of first refusal over any transfer. So if I'm purchasing Victoria's shares, I'm a VC fund, Victoria wants to sell me, $1 million worth of shares at $1 a share. I'm not an investor. And then, Walter Matos on this call I'm seeing is a current investor in your company. He wants the right of first refusal to buy those shares instead of me, who's the outside investor. The reason for that is, one, because people want to keep investing in your company if they like it. It's also to prevent you from selling, as a founder, selling your stock at a discount or at a low price and messing up the market price of the shares without them, right? So if otherwise I could transfer shares to my friend at a 90% discount without giving the investors that same opportunity. So that's what that's covering. So next I have founder vesting, and then I'm going to basically wrap. There's a question there about, is 36 months, is that a little tough? You're right. So this provision, there's brackets around it, or there's one bracket, it looks like it's missing one. This provision there's a lot of variation in where this lands. Recently in the US, the market has basically been, in most cases, not to ask for founder revesting, or if you are going to do it in a limited manner, right? And all this means is if you weren't initially subjected to vesting, to ask you to resubject some of your shares or all of your shares to vesting, so that you can't just raise their money and then leave the company. And then, like, if you're the sole founder, they're stuck with nothing. They can't go hire anybody because you've used up all the equity. There's very significant differences between market practice in different regions on founder vesting. In Europe, there is almost always founder vesting, revesting, and it is generally much nastier than what we would have in the US. So much less founder-friendly jurisdiction from a vesting perspective. Now that's not to say like what's founder-friendly, what's not founder-friendly. A lot of people, and I would agree, argue this is really about aligning incentives for the long term, right? This is not a punishment. Nobody's taking away shares. It's just changing your current vesting structure to ensure that you're not going to leave in 6 months, or that if you do, that the company can survive because they can reallocate your founder shares to a new CEO or a new COO and hire the people needed to let the business survive. So what is standard here? Again, it's tricky. It's something, when you get to this, you should talk to your lawyer and they'll be able to tell you what's standard in your market and based on your stage, right? And this, again, stage being important. At seed, you should expect to see this. At a Series B, typically we wouldn't expect founder revesting in most cases, unless it was super quick. And we can ask questions on it, but let's pop down. That's basically it. You know, there's a note here on documentation. These financing documents, like this is going to turn into a big set of documents. Those documents are drafted on what we call the Nvca Forms. The Nvca is the National Venture Capital Association. It's an association of US venture funds and law firms that prepare these model documents that we work off of. They're not forms like a safe. They're not something you can like print off and use. They're much more complicated, many footnotes. There are many hundreds of pages, but it allows these deals to move pretty quickly, so that it, you know, because we all use the same base form. It's not, you know, some lawyer saying, oh, I'm going to use this form I like better. We all base everything off the same forms. And there's a UK, I think it's the BVCA in the UK, and then in Canada, the CVCA, and they all are generally fairly similar, right? And then if you're doing a deal, if your company's in the Caymans, that's going to be based on either Nvca US forms or BVCA, depending on who your investor is. Only other note here, I guess, would be just always important to remember the company typically pays the legal fees of the investor. Not a big deal, but always, you know, some people are shocked that like, why am I paying their legal fees? It's just sort of the way the market works and has to do with the internal structure of a VC fund. But so that's that. So now I think I'm happy to take questions. I guess in terms of best way to do that, I'm just going to scroll through. If people want to pop them in the chat, can.
There's already a couple in there. Let's do that.
Yeah. So Paul Bogar. Will investors have access to my company's secret recipe? What if I do not want? That's a good question. There are confidentiality restrictions in these documents. The reality is your small investors have access to nothing if you don't want to give it to them, right? You don't have to give them detailed financials or anything else. Now you may, and it's generally a little weird if you're not willing to share how your company's doing or not give them updates. They're giving you their money. It's a reasonable request for them to know how the company's performing. What you would not ever do is give them access to your source code. Your board could access your code, right? They sort of access company, but in practice, the answer is no. And there are then restrictions in the documents. Everybody's bound who's signing onto these by confidentiality restrictions. So they're all basically signing an NDA. It's built into the documents. There's also competitor rules. So there's a definition included of competitor, which basically says if, you know, your VC fund invests in your direct competitor in a substantial way, so they own, say, it's usually like in excess of 20%, you don't have to give them information anymore. You can't get rid of them or make them go away, but you can limit what information they have access to if they're substantially invested in a competitor. So the answer is no, they don't have access to your secret sauce, assuming your secret sauce that you're referring to is, you know, source code or other things. If it's like business style and practices and sort of how you hire your team and what market in like more business side information, yes, your board will have access to that, who are going to be investors, but generally speaking, no, they don't, and you can prevent it. Investors vesting. No, investors are not ever going to be subject to vesting. The way vesting is designed for if you didn't pay for the shares, right? So if you purchase something, you own it. When you guys are founders and you initially start, presumably you didn't buy your shares, right? You were just granted them. So the argument is that you have to earn into them with your sweat equity, right? If you're not paying for them. If you funded your company yourself in a substantial way when you were starting, let's say you put in $1 million of your own money or 500,000 or 250, whatever it might have been, that is a very good argument for reducing the amount of your shares that should be resubjected to vesting or otherwise tweaking the schedule because you already paid for them. You can say you've already sort of earned them. So no investor vesting, but you know, if you are also an investor, it's a good argument sort of against founder revesting. Bill has a question here that you have a term sheet, 20% for 3 minutes. They want a ROFR on any future investors. That is problematic, and you should talk to your counsel about that. If it's actually a ROFR, meaning they have a blocking, like they have a right of first refusal to do all of your future rounds. What they should have is a right of first offer to participate. Typically, we only see a ROFR right in that way if it's a strategic investor, right? Like some big corporate, and you need to be very careful with those. Strategic investors are great, but if you give them too many rights, to make your company sometimes less attractive to traditional sort of private investors, right? Only because they're worried that they're going to exercise too much control over you, or that their incentives will be different. What questions do we have in here? What is the maximum liquidation preference you should accept? Okay, I'm sorry that I didn't mention this. That's a good call out. It's a 1x liquidation preference. 1x non-participating. No multiple X liquidation preferences are within market. Again, that is a big, in a down market. I would not be surprised if some people on this call might end up seeing a term sheet that says, 3x liquidation preference. That is not normal, and that is not a reasonable ask. The only time multiple liquidation preferences are viewed as sort of a correct approach or standard approach would be if your company is not doing well, and therefore the person is looking for a lot of downside protection. Notably, let's say you raise your Series A at a valuation that was far too high, right? Because the market was hot, and you're not performing well, and you're doing a down round, and you're raising at a substantially lower valuation. You might see a multiple preference there because they're worried about your performance. Anti-dilution we actually didn't touch on, which was my fault. So anti-dilution should be covered. I see this question.
Yeah, let's do it.
Sorry about that. That is in there. Keep scrolling up. It's at the top of the page.
There you go.
Oh, one up, yeah. So anti-dilution protection. What anti-dilution protection means? What it means is if you issue shares that are not in a category of exempt issuances most notably being shares out of your option pool to employees, or there's a number of other lists, like it's usually, but that's the big one, and service provider shares, right? If you have to give your venture debt bank a warrant, right? If you raise a facility from SVB or one of the big Italian lenders, or somebody else, right? Then you would want to, that would be covered. But generally what it means is if you issue shares at below the price that the investors got them, there's an adjustment made effectively in their price, right? It's done by the multiple types. Really, there's two types of anti-dilution protection, one of which is acceptable and market, one of which is not. Broad-based weighted average is what we call the acceptable good version. That's all you want to see. That is the ubiquitous standard. The other type, before I explain it, the other type is called full ratchet. That's the other. There are other ones that are used in more structured deals, but full ratchet and broad-based weighted. What full ratchet does is, let's say you sold your investors shares at $1, and then you do a down round, or you otherwise issue equity at 80 cents a share. Basically, their price gets shifted from the original investors from $1 down to 80 cents all the way, regardless of, even if you only issued $100,000 worth of shares or $250,000 worth of shares, and but you previously raised $10 million. Broad-based weighted average is a formula, and it's, I forget it off the top of my head, but I've written it 5,000 times. Broad-based weighted average, what it does is it takes into account the amount of the dollar value of shares you issued. So that way, let's say, you previously raised $10 million at $1 a share, and then you sell $100,000 worth of shares at 50 cents. It's not going to cause everybody, all prior investors, shares to reprice down to 50 cents. It's going to take into account that it was only 100,000, and likely in that situation, they're going to be at like 98 cents. Or instead of $1, right? It's a much more reasonable provision that sort of takes things into account. What anti-dilution is not, and I'm sure most people on this call know this, but I do like to say it because I find that the word anti-dilution gets confused sometimes. What anti-dilution is not is a provision that says that somebody's shares are not dilutable. All shares in a company, generally speaking, are dilutable. Issuances of new equity dilute everybody, including your investors, including you. It's price-based, right? So this is just how we adjust their price for dilutive issuances that are outside of the sort of acceptable set of exemptions.
I know we have many other questions, but I do want to navigate to all the resources that Orrick offers to founders. This is a page I found on, let's see, where's the Orrick Startup Library. Are there any ones that you want to highlight?
Orrick
This is the one I was,
Forms?
yeah, this is the one
Yeah.
I was going to share with everybody. Can everybody
Yeah.
see that? This is Orrick Startup Forms. If you want to go over that and any additional resources that our founders can
Yeah,
expect to find.
We have a lot of them. We also have video series on this stuff. We have tools,
right here,
resources, apps built to help you, like future founders, a podcast series. There's Series A ready, which you can use to make sure your company is actually ready to raise a round.
Yeah.
There's also basic formation docs on there, right? That are listed, right? They're just everything you might need. The safe is on there. Orrick invented the safe with YC. We're a long-term partner. We built that with them. You can get the safe anywhere though. You don't need to come to our website to get it, but we'll take the traffic, I guess. And then just basic documents on there. You should never incorporate and try to do things without a lawyer. Even if it's not us, go hire one, please. I promise you'll be very happy you did when you go to raise a round and don't have to pay a lot of money in legal fees to get things cleaned up, right? Or otherwise blow your round because you didn't take care of some fundamentals and basics when you were getting started. But there's plenty of resources on there. We're also all around and available if you want to get out there. Yeah, Series A ready, you can take a test, sort of see how things work. We also have privacy compliance tools and other things of that nature that you can take a look at if you're looking for sort of running tests on your products to see how your privacy compliance looks. We got most of it. There's very little in startup world, or maybe nothing we haven't seen and don't do. So if you need any resources or you're looking for anything, feel free to reach out. We have a team of folks who are happy to help.
There's an interesting question about venture debt as a substitute for debt or structure into the round, or substitute to capital.
Venture
what are your
debt
thoughts?
So there are now a number of substitutes for raising venture financing out there, right? There's like revenue-based financing from CapChase or Pipe or any of the other players. And there's also debt. Venture debt traditionally is actually not a substitute. What it is it's tacked on as additional. It gives you what we call, extra juice in your round. So for example, SVB, Silicon Valley Bank, which is the largest venture debt lender times 10, they won't lend you the money for your company to run the business unless you have raised the venture round, and they're basing your ability to pay them back in large part on, they may not even tell you this. They may say it's all about your recurring revenue. A lot of what they're basing it on is their confidence in your ability to raise more equity capital and pay them back with it. So it's not a replacement. I mean, you may be able to find some unique family office or debt provider that's willing to give you debt instead of raising capital. And if that works for your business, that can be great. It's, the market is generally a lot friendlier towards debt now than it used to be, which was, VCs used to hate debt. But venture debt is a round juicer. So if you raise a $5 million round for whatever reason, and you wanted to raise 10 and your company you weren't getting the traction you wanted, but your numbers look good, you can go get, call it, $2 million of venture debt, which is low interest debt. It's generally, call it prime plus. It's going to be, if it's SVB, call it 5 to 7%, or 5-6. If it's one of the big other lenders, it may be 10-11%, but it can be relatively cheap as investment capital goes, and can be great. But it's not a substitute. It's additional fuel for your already burning fire.
And given this current market trend we're looking at, winter is coming. Some may say winter is here. Your general guidance, and you already shared a couple of great ones.
The general guidance is to one, don't listen to all the negativity. A lot of it is people who don't know what they're talking about or just want to say that everything is burning because that's the kind of person they are. The market is definitely dipping, but this is not a calamitous madness where nobody's raising money. We're closing in Europe in Q1 alone, and we're global, and most of our lawyers are not in Europe. We did 90 deals in Europe in Q1. That's like 3 a day, right? Or 80 something. In the US, it was a lot more than that. There's a lot of deals happening every day. What I would say is what investors, and I represent a lot of VCs, like a large number, what they're looking for now are less hopes and dreams and more real business models. They want to see what you're going to be able to do with the capital. And so you want to sort of tailor your pitch a bit to that, about sort of more realistic. The other thing is, if you have the opportunity to shore up your balance sheet and raise money now, do it. Do not play the I'm going to be worth more in 3 months game, so I'm going to hold off on raising. If somebody wants to give you money and it's a reasonable offer, take the money, because we don't know how it's going to fully filter down right now. And so, I have companies I have a client, Series B company, they just raised 70 million. They closed in December. They're going to add an additional 20 million to that round, which is 6 months ago at the same valuation. In a normal market, you would never do that because it's horrible signaling, right? Or not great signaling. They just want to shore up their balance sheet because you don't know how things are going to play out, right? It's winter, so stock up your canned goods, right? Make sure you got a little extra in the tank. That being said, a lot of this is just because we don't know, right? We don't know how the markets are going to move, so you want to be prepared and you want to have a little extra cash. And also, you should expect that a lot of what we'll call tourist investors, right? Family offices, hedge funds, others who really aren't startup and tech investors, but were playing in the space in the last few years, they're going to exit the market because they're about to lose, or have in the last 6 months lost a lot of money. So you're not going to see them as much, which cuts out the total amount of capital available, right? And the total amount of sources. So that means that you have to be more sort of diligent and targeted in your fundraising. That being said, there is a record amount of money sitting in venture capital funds, trillions of dollars sitting in funds waiting to be deployed. If VCs don't deploy it, they don't get paid. So they have to spend the money. It's an allocation question, right? It's not the money has already been invested. They have to spend it or they don't get their management fees, and they certainly don't get any carry. So they're going to spend it. You just got to make sure you're advertising yourself as the right company for them to spend it on.
Very wise words. This is such a useful session for our founders. Thank you so much, Max Cantor, partner of technology companies group at Orrick, Harrington and Sutcliffe LP. So thank you so much. And thank you, founders, for your participation.
Thanks so much.
Yeah, and then we'll have the recording up. So it's going to be on our YouTube channel as well as on XTC website under Learn Bootcamp. So thank you for joining us today. Great session, Max.
Have a great day, guys.
A great day. Bye.